Well, three letters in the mortgage world that probably get maybe a bad rap. PMI. You probably heard about it. You've probably been told stay away from PMI. But is that the case? We're going to tell you what it is, explain it a little bit more, and tell you if it's really a bad thing to carry PMI. That's coming up next on the Smart Mortgage Show. Welcome in. Glad to have you. I'm Ben George. He is Bill Linton. He is the regional president at Cross Country Mortgage. You can find him online, smartmortgageshow.com. We're glad you're here on the YouTube channel. Going to answer another question today, kind of give you a little more clarity on a topic that comes up quite a bit probably for you, Bill. PMI, right? Is that a conversation you have frequently with clients when they're getting into a mortgage?
All the time, Ben. It's like a bad word.
Oh, I think we've been trained. I've, as early as I can remember about looking for my first home is you want to avoid PMI, right? You don't want to carry that. That's going to be more than you need. It's going to cost you money. It's going to be a little bit of a burden. It felt like you weren't doing your best financially if you're taking on PMI. So I want to get into that a little bit with you today and explain it. I know it'll help me out a little bit, plus people that have questions and maybe haven't gotten a mortgage before that are going through the process for the first time. Hopefully this will help them a little bit as well. So let's just start, Bill, with what is PMI?
So PMI is private mortgage insurance. And, the common mistake that people make is they think that it insures them, the borrower or the homeowner. It does not insure them at all. It is the lender saying, if you want to put down less than 20%, we feel like that compromises our equity position, makes it a little riskier. And for any time there's risk, we have insurance to mitigate the risk. So we're asking that you take out an insurance policy and pay for it so that if there's a foreclosure and the lender has losses, they'll cash in that insurance policy to make up for the losses to make them whole. That is, in short, what PMI is. When
did the 20% number kind of become the standard? I don't know the history of PMI, obviously, and I'm assuming that's just kind of the range in which maybe the value of a home could fluctuate just, I guess, over history. Is that kind of how they hammered in on 20% and not say like 10% or 15%?
I think the 20% number is important to a lender because it gives them enough of a buffer that, God forbid, the home gets foreclosed on. They need some kind of buffer to pay to sell the house because they're just like anybody else. They're going to have to hire a realtor. They're going to have to pay attorneys. They're going to have to do all the things to unload that house. And realtor's fees and transfer tax is 7% right there. Add in other miscellaneous fees, you're at another 3%. So you're at like a 10% minimum cost to the lender to sell the house. So they've built in a buffer to make sure that they don't lose money by adding another 10%. So for the longest time, you could not borrow more than 80% of the value of the property. And then somewhere in the 80s, somebody had the brilliant idea to say, you know what? We'll lend you more than that. You can put less money down, but you're going to have to carry this insurance policy. And that's going to make us feel good about lending the money with such little skin in the game from the buyer. And, the first mortgages, you had to put 50% down.
Wow.
Yeah. So, the more you put down, the safer bet it is for the bank.
I guess homes were a little more affordable when you're putting 50% down, right? In terms of just the number, right? I think, you could probably get a home for $20,000 or $30,000 and 50% isn't quite as big.
So I think there's truth to that, but I also think if you look at ratio and proportion, incomes were proportionately much lower. And it wasn't until Fannie Mae, the government created the quasi-government agencies of Fannie Mae and Freddie Mac. That's technically like an insurance policy that says if you're Chase Manhattan and you write the loan all to our specifications, then if they default, if the borrower or the homeowner defaults, we'll make you whole. So that got us up to 80% loan to value.
Gotcha.
And then to go further, we added another layer of insurance.
More and more layers. Well, what does it mean then for the home buyer in terms of PMI? If they aren't able to put 20% down, and we have plenty of episodes and shows and conversations about that 20% number and whether you need to put that down. But speaking specifically to PMI, what is the bottom line for someone then that isn't able to put 20% down? What is that going to mean to their mortgage?
So basically, we get a lot of people that call, and we always ask, what's your goal? Are you looking to do the least amount out of pocket? Do you want to do 20% down? Is that a goal? And a lot of times people are like, I've got to avoid PMI at all costs. I just can't have PMI. And I'm like, all right, well, how much money do you have saved? Well, you have $80,000. And I say, well, to put 20% down and avoid PMI, you're going to spend every last dollar you have. I don't care. I don't care if I spend my rainy day fund. I just don't want PMI. And then we suggest, well, and actually right now we have a product that allows you to do 15% down without any adjustment to the interest rate or having to take PMI. So we've kind of changed that narrative a little bit, and that inflection point to now you could only put 15% down and not have PMI. So that's a good thing. But let's just say in general, if you don't put 20% down, you're going to have PMI, right? Let's say that you could easily afford 15% down, but to do 20% down, you're spending every last dollar you have, which we don't recommend. When we put the numbers in front of the buyer or the borrower and they see that, oh, wait a minute, I was actually able to hold on to $25,000 or $20,000 and it only cost me an extra $20 a month in PMI. It's really inexpensive for me to have the luxury of holding on to that nest egg of $20,000 or $25,000. And the only thing I have to do is pay an extra $20 or $25 a month extra in PMI. So when you put it on paper and you show and you explain it that way, it's not such a bad thing.
Yeah, so I'm going to answer the question then. Is PMI a bad thing? It sounds like maybe it's not. And maybe too, I think there's been, this kind of shift in thinking financially in terms of investing and getting the most out of your money. And I think that's part of it too, right? Having that liquidity, you might be able to grow your money better by having it invested somewhere else or having the option to have that money rather than having it tied up.
Amen. We say all the time, if you put that money into some sort of an investment vehicle, it's going to earn a lot more than that $20 or $25 a month cost of PMI. And PMI truly is only a good thing because without it, all it does is gives you options. Without it, you have to put 20% down. There is no other option. It's only PMI that makes less down available to you.
So if you can comfortably put 20% down on a home, great. It's a great position to be in. But if you can't, it's not necessarily a bad thing either. So a little bit of clarity on PMI. And again, it'd be part of the conversation you'll have with Bill and his team at Cross Country Mortgage when you're going through the process and seeing what options are available to you. And as always, you can start by taking advantage of the free 15-minute mortgage and loan consultation. Just log on smartmortgageshow.com or just give them a call directly at 484-352-4151. Good stuff as always, Bill. We appreciate your time here on the YouTube channel. If you haven't subscribed, please do so. It helps us continue to grow, and we'll do it again soon. Thanks, Bill.
Thanks so much. Thanks for tuning in.
This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.